Hi, and welcome. Today we're going to be breaking down the basics of mortgage so you can understand your options, feel confident, and make the best decision for your future. Let's start with the basics. A mortgage is a loan used to buy a home. You borrow money from a lender and you pay it back over time with interest. That loan is secured by the home itself, and you'll make monthly payments over the lifetime of the loan, typically 15 or 30 years. There are several types of mortgages, and understanding your options is key. The most common types are fixed rate, adjustable rates, also known as ARMs, and government-backed loans like FHA, VA, and USDA. Let's start with fixed rate mortgages. These have the same interest rate for the entire term of the loan. That means your monthly payments stay consistent, which makes budgeting easier. Fixed rate loans are great choices if you plan on staying in the home for long term and want a predictable budgeted payment. Now, let's talk about adjustable rate mortgages, ARMs. These loans start with a little bit lower of an interest rate for the initial period, usually 3, 5, or 7 years, and that rate can actually adjust periodically based on the market. That is also an option. Next up are government-backed loans, which can offer big benefits to qualifying borrowers. First, the FHA loans, it's backed by the Federal Housing Administration, and it's a popular option for first-time home buyers. FHA loans have lower down payment requirements and a little bit more flexibility with regards to the credit, making homeownership more accessible. Then there's VA loans. This is one that is amazing and only available to veterans, active duty service members, and certain members of the National Guard and Reserves. VA loans require zero down payment, offer competitive interest rates, and don't require mortgage insurance, which can save you a lot over time. The next option is a USDA loan. It's designed for buyers in rural areas and some suburban areas. Like VA, USDA does not require a down payment. There are income limits and area specifications, so you need to know what they are. Now let's talk about mortgage terms and rates. The most common loan term is a 15-year or a 30-year. Shorter terms typically have lower interest rates and save you money in the long run, but they come up with a higher monthly payment. When it comes to rates, you'll be able to choose between a fixed rate or an adjustable rate, and we'll discuss that early on. And don't forget about the annual percentage rate, your APR, which includes both your interest rate and any lender fees. It gives you a more complete picture of the true cost of the loan. You might also hear the term rate buy down. This is when you or the seller pays extra upfront, called points, which is 1% of your loan amount, to lower the interest rate for the life of the loan or just for a few years. A buy down can reduce your monthly payment, making homeownership more affordable in the early years. It's often something that you can negotiate with the seller or the builder. So, how do you know what's the right loan for you, and how do you start? You start by asking yourself a few questions. How long do you plan on staying on the home? How stable is your income? How much do you have for a down payment? So let's recap the key takeaways. A fixed rate mortgage offers stable, predictable payments. An adjustable rate mortgage, an ARM, may save you money up front, but it comes with some risk of payments later. Government-backed loans like FHA, VA, and USDA offer unique advantages for eligible buyers. And always compare the terms for rate and APR when making a decision. We're here to help you navigate your way through the mortgage options for the one that's right for you. And that is one of the most important parts. So reach out anytime, and happy house hunting. But before you go find that house, make sure to comment and like, and always share if you found this worthwhile.